This is one of the World Trade Center towers in Manhattan.
What?
Hello?
Hello, Nicholas, it's Tom from London. I'm just wondering, have you seen what's happened in New York?
No, why, what's going on?
A plane's crashed into the World Trade Center.
What? Are you joking?
No, turn on your TV.
Oh, shit.
Do you think you could have crashed into one of those towers?
God, no.
Why?
Because it's a no-fly zone for planes, obviously.
It's Tom Pearson. Hey, Logan, can you tell me if you can see any planes? Any type of plane?
A plane? No.
Are you sure?
Yeah, I'm sure. I can't see any.
Is that normal, do you think?
Actually, no.
Mark!
What are you doing in here?
We've got to short the market.
What are you talking about?
We've got to bet against the market before it collapses, and we've got to do it now.
And what makes you think the market will collapse?
Because it's a terrorist attack.
And how do you know that?
Well, I can't be 100% sure, but it doesn't look right. I mean, it's a no-fly zone for planes, there are no clouds in the sky, and I've just spoken to someone in the US who's told me the airspace was closed.
And you're absolutely certain about this?
Hello, everyone. Welcome to the special weekend edition of Markets Around the World. I'm K2, and I'm excited to guide you through today's packed agenda. We'll dive into the latest data, break down key macroeconomic trends, and highlight the crucial levels you need to watch. If you're as passionate about markets as we are, don't forget to subscribe and join the conversation as we explore how global markets are interconnected. In this episode, we'll go over what happened in the stock market last week, from major earnings reports to the biggest headlines. Let's jump in and take a closer look at what's been moving the markets. Stock market investors were pleased when the Federal Reserve delivered a larger-than-expected interest rate cut in September. However, strong jobs data in the coming week could trigger concerns, as it may reduce expectations for further rate cuts. The issue is that strong economic data could lead investors to scale back hopes for additional monetary easing, creating a scenario where good news for the economy is seen as bad news for equities. While the Fed's 50 basis point cut helped ease recession fears, it also revived concerns that inflation may not return to the 2% target soon. As a result, inflation expectations have risen, pushing up short and long-term Treasury yields. Japan's Nikkei 225 fell nearly 5% on Monday after the Liberal Democrats chose former Defense Minister Shigeru Ishiba as the next Prime Minister. Ishiba, set to succeed Fumio Kishida on Tuesday, signaled he would largely continue Kishida's economic policies. Markets had viewed Ishiba's rival, Sanae Takaichi, as more investor-friendly. The Nikkei was down 4.4%, trading at 38,062.06 yen an hour into the session. On Tuesday, People's Bank of China, Governor Pan Gongsheng announced major stimulus measures, described by one economist as the most significant since the pandemic. By Thursday, the Hang Seng Index hit a one-year high after China's Politburo hinted at further steps to support economic growth. The Hang Seng was up 13% for the week by Friday. In this week's ETF wrap, Isabel Wang discussed the renewed interest in ETFs holding Chinese stocks and explored what these stimulus efforts could mean for investors. Nike is bringing in a new CEO, Elliott Hill, following a months-long decline in sneaker and clothing sales. Investors welcome the leadership change, but analysts say challenges remain. Nike reports its fiscal Q1 earnings on Tuesday, with low expectations due to cautious consumer spending amid inflation. While some believe better-than-expected results may not fully ease Wall Street's concerns, others think the new CEO could offer the company some leeway. Nike shares have rallied on the news, but remain down 17.6% for the year. Hill will officially take over on October 14th. Investor hopes for a soft landing in the U.S. economy will be tested next week with key labor market data, following recent disappointing jobs reports. The S&P 500 is up 20% year-to-date, on track for its best January to September performance since 1997. driven by optimism around the Federal Reserve's efforts to tame inflation and a recent 50 basis point rate cut. However, concerns remain that rate cuts might not prevent a downturn, making the upcoming October 4th employment report crucial for Wall Street. Now let's dive a bit deeper into this topic. I want to give you guys more context and data to really understand the situation we're in. We'll begin with this data. To further illustrate the current economic landscape, let's take a look at a chart comparing real Fed funds rates in relation to the neutral rate during past soft and hard landings. Soft landing, black line. In scenarios of soft landings, we see real rates cut slightly below the neutral rate, around 200 basis points, and remaining stable. This indicates a more measured and cautious approach by the Federal Reserve, which allows the economy to gradually adjust without tipping into recession. Hard landing, brown line. Conversely, during hard landings, the rates are cut significantly deeper, dropping well below the neutral rate. This reflects a more aggressive response from the Fed in an attempt to combat sharp economic downturns, often resulting in greater instability in the financial markets. Current path, blue line. Our current trajectory, indicated by the blue line, suggests that the recent 50 basis point rate cut may produce mixed signals. It raises questions about whether we are headed towards a soft or hard landing. The uncertainty surrounding this decision could lead to volatility in both consumer sentiment and market performance. Now let's take a look at how different sectors have historically performed following the first Fed rate cut. This chart provides valuable insights into sector performance relative to the broader market. Top performers. Consumer non-cyclicals. These stocks have historically outperformed, with an average gain of plus 7.7 percentage points above the market. This reflects the resilience of essential goods during economic adjustments. Consumer cyclicals. Following closely, these stocks show an average increase of plus 7.0 percentage points, benefiting from pent-up demand as consumers begin to spend more. Technology. This sector has averaged plus 5.2 percentage points, often driven by innovation and investment opportunities that arise during easing monetary policies. Healthcare. With an average performance of plus 4.5 percentage points, healthcare stocks also tend to hold steady, providing essential services regardless of economic conditions. Weak performers. Finance. This sector has struggled, showing an average decline of negative 8.2 percentage points as lower interest rates can compress margins. Utilities. Typically viewed as defensive, utilities have underperformed by negative 7.6 percentage points, possibly due to reduced demand for safe haven investments. Energy. This sector has averaged a minus 6.2 percentage point decline, reflecting ongoing volatility in energy prices and demand. Overall, since 1973, the S&P 500 has returned an average of 4.9% 1 year after the first rate cut. Understanding these historical trends can provide us with a clearer picture of what to expect as we navigate this current economic environment. As we consider the implications of the recent Federal Reserve actions, one pressing question arises: is unemployment set to spike further? Last week, the Fed initiated a new rate cut cycle with a 50 basis point reduction, echoing similar moves made in 2001 and 2007. Historical data from those cycles reveals some concerning trends. Unemployment rate increases. In both previous cycles, the unemployment rate surged by 1.5 percentage points in 2001 and 1.4 percentage points in 2007 within a year, following the first rate cut. Decline in job openings. Concurrently, job openings plummeted by approximately 29% in 2001 and 31% in 2007, translating to 1.5 million and 1.4 million fewer available positions, respectively. It's important to note that the effects of falling rates typically take 6 to 24 months to materialize, meaning the immediate impact may not be felt until much later. Given this historical context, we must ask ourselves, is the Fed behind the curve again? The concern is that, despite the recent cuts aimed at stimulating growth, The delayed response in the labor market could lead to rising unemployment in the months ahead, mirroring patterns from past economic downturns. As we analyze the latest inflation data, we find that while core PCE inflation is stalling, headline inflation is still on track to meet the 2% target. This report may not be the ideal outcome the Federal Reserve was hoping for, but it does highlight a solid downward trend in inflation overall. Importantly, there's nothing in this data that should alter the Fed's outlook on future rate cuts. The persistence of headline inflation at lower levels suggests that the Fed can maintain its current course without feeling pressured to change its strategy. In summary, while the situation is not perfect, the steady progress in inflation rates provides the central bank with the flexibility to navigate upcoming economic challenges. Key earnings reports to watch this week. September 30th, Monday. Carnival Corporation expected. EPS 1.15 before bell. Compass Minerals expected EPS negative 0.74 before bell. Carnival Corp and PLC time not specified before bell. October 1st, Tuesday. Acuity Brands expected EPS $3.85 before bell. Cal-Maine Foods time not specified after bell. Lamb Weston expected EPS 0.73 after bell. October 2nd, Wednesday. Conagra Brands expected EPS 0.59 before bell. Constellation Brands expected EPS $4.12 before bell. October 3rd, Thursday. Angiodynamics expected EPS negative 0.15 before bell. Constellation Brands expected EPS $4.12 before bell. October 4th, Friday. Apogee Enterprises expected EPS $1.20 before bell. The Fear and Greed Index currently stands at 68, indicating a sentiment of greed among investors. This is generally seen as a warning sign, suggesting that the market may be nearing a top, especially following a positive September, where the market showed resilience. Given that the index has remained in the greed zone, it may prompt caution among investors. Historically, high readings in the greed zone can lead to corrections, as some investors may start taking profits. It's essential to keep an eye on economic indicators, upcoming earnings reports, and potential shifts in market sentiment to gauge if this trend continues or if a reversal is on the horizon. What are your thoughts on the current market dynamics? Now let's take a look at some charts, starting with the SPY one-day chart. The price remains bullish as we approach the end of September, with only 1 day left in the month. If the price breaks above 573, that will indicate a bullish trend, and it's a good time to go long. However, if the price fails to break above that level and experiences a decline, my downside targets are 564 and 554. The market is currently expecting an implied move of 99 points this week. Will we see another new high? All right, ladies and gentlemen, that's all for this video. If you find a value in this video, please like and subscribe. If you have any question out on the comment below, I will get back to you as soon as I can. Thank you for watching. I will see you guys later. Bye for now.